Rod Gooseman, Spoon for Risk. October 25th, we're taking a moment to show you a substantially improved arrangement for tracking the trend. The problem with any trend indicator that we've ever used, just a standard type of indicator, is the lag. We have used in the past, for example, just to track the trend, not for entries, but to track the trend, momentum bars, using a variety of different indicators. In particular, a Zurich stochastic has worked well in identifying the trend. But when the trend changes, it's late, and of course it's late. But this particular trend indicator, using a range bar, a momentum bar with a range of 1.25, has worked in the past reasonably well. But you can see that even in this particular case, from the low, it took almost a little better, really, than 15 minutes before the upward trend was confirmed. And then, of course, at that point in time, if you were looking to get into this trade immediately, you might have gotten stopped out when it came back and found some support on this projected low value area. But now, as the market has moved up, all right, and moved right up into this descending low value area, why this is all shifted and we're moving down again. And with the exception of the RSX, really on this last bar, which is way off the high there, there's nothing there that's suggesting that this is moving down. Yet, if you were holding a long trade, your profits, even from up here, or at this point in time, if you were holding a long trade there, and you're still thinking this is going up, well, you haven't got much left in your long trade, because the indicator itself is still long. So what we have done to combat that is use the threshold indicator. Now this is going to take a little bit of explaining to do. We could be showing you this with just the premium threshold indicator, but we're going to take the time to mention that we have adapted the premium threshold to read the ticky as well as the premium of the YM, and place that all on the same chart. Now, point of the matter is this. We are plotting a 1-minute chart here. This is a 1-minute chart. But it emulates something even longer, depending upon how we set up the right strength of the pivot bars. The right strength of the pivot bars. Now, when a new threshold is plotted on the screen, how long it takes before that threshold shows up on the screen is dependent upon the right strength of the pivot setting. So with a right strength set to 2, that means that it's going to take 2 minutes at least, maybe a little longer, but 2 minutes at least, but not more than 3, for the trader to know where the pivot actually took place, or to respond to what is taking place. Because the pivot, and you're going to see it right in here. This is a 1 minute bar. You've got a low pivot right here. The market is moving up. Now, unless this moves down further, you're not going to see this propagate. But we'll just show you this in real time. It's going to, the low threshold associated with these lows on the premium and the ticky will not show up until the close of this second bar. And just watch this as we move along so you get the feel. And as we wait for that to propagate, the point is that if you were going to use this kind of methodology, then it's a 2 minute lag. It's a there we go. It's a 2 minute lag before you know precisely where the threshold level is, if you're relying on the indicator to show you that. Now, you can just go in and read it manually and know instantly where that is, but from the standpoint of just an indicator, it's going to take you 2 minutes. Now, what's the point of that? Well, if you're using this as a basis for executing the trade, you just want it to do its thing, well, it's a 2 minute lag, but it's a whole far cry from a 15 minute lag, which is what we just showed you using a range bar. Because now you know that there's been a pivot here. You would have known that just by looking at it, that there's a pivot right there on the premium, and that's why we teach you to read the raw data. But that having been said, the indicator itself will plot it after 2 minutes. And that's going to be giving you a fairly good indication of any trend changes that are taking place. A 2 minute lag isn't so bad. At least you have it plotted on the screen. But again, if you just read the raw data, it's pretty obvious and easy to see. So, for example, as you moved up here and you hit this high at 40.75, this again gave you a slightly lower high at 40.50, and then one more time at 40.75 at that pivot point. Well, it was pretty easy to see that since you have that line established here, it takes 2 minutes before that's going to plot. But by the time you reach back to that same price, you instantly know that you didn't make it. You didn't make it up to that threshold, and there is a divergence there. This is coming down. There was no lag if you just read the raw data, which is, of course, what we recommend. So why use these lagging indicators when premium can tell you pretty much instantly whether or not there's a potential trend change going on? Now, the same data, if you're so inclined to use it, this is the same data as this. 1 minute chart, same settings with one difference. The right strength is 5, so that means it's a 5 minute lag. As you just saw that propagate right in here. 5 minute lag to know that there was a low pivot there. And, you know, some people like a 5 minute chart. I think that's horribly low, horribly slow. And the whole world can change in 5 minutes. So, yeah. But if you're so inclined to do so, all you have to do is just set this set the right strength to reflect the delay. And therefore, if that really wasn't a low threshold, in a 5-minute period of time, you're going to find out. But in more instances than not, 2 minutes will do. A 2-minute lag will do. I personally prefer to use a much faster chart. Now, we can use the same approach using a 20-second bar chart. Now, this 20-second bar chart has basically the same settings, but it's on a 20-second bar. So using a right strength of 2, that means that it's going to take you 40 seconds before you get a plot on the screen. Once again, when you're reading the premium, you can pretty well see almost instantly whether or not your divergence is taking place. And that's what we're ultimately all about. We're all about trying to get the trader to read the premium feeds as well as the ticky accurately. And this enables you to get the sense of what it is you're doing, so that ultimately you don't even have to wait. As soon as you see where the premium is telling you the market is going, you're in a position to respond. But again, if you're just relying upon the indicator to do its job, you get a 40-second wait here, 2 20-second bars. Okay. Now, if you wanted a little longer than that, you can use 5 20-second bars, or anything in between. This is now a 100-second delay, so a little less than 2 minutes, and you get the same results. So you could move this back, to 3. And then you'd have basically a 1-minute delay before the indicator will plot. Ideally, you want to read the raw data. And so 20 seconds is the way you want to have the screen being plotted. That's fine. But as you can see right in here, look at this. Look at what's happening to the lows of the premium. You've got a nice situation developed there at the low, and you can see that we're moving from the low. The lows of the premium are moving up. Doesn't take you any time at all to see that. So, depending upon what your preferences are, this kind of arrangement can help you to clearly see where the premium is in relationship to the Spoos, or the YM for that matter, and then you're able to anticipate your support, your overbought, your oversold levels really on the premium, as well as the ticky here. And in that respect, anticipate where you want to execute a trade. Works extremely well, and there's virtually no lag. Not once you learn how to read this. Now, if you really want to get down to the nitty-gritty, you drop to a 5-second chart. Sometimes that's a little too fast, depending on market conditions. But this 20-second chart for plotting purposes, once you know how to read the premium, is just fine. You can use that, and you can pull your trades that really quite effectively with that kind of arrangement. And the chart isn't so busy. either. But 5-second chart is going to give you some real strong context of what is exactly happening, because we can at times even be fooled with a 20-second chart when we're trying to figure out whether there's any divergence going on in the premium, and the only way to do that is to really look at a much faster chart, 5 seconds. This is as fast as you're going to want it to go. So, much better arrangement than this. Okay, you've just been told, as the market is tagging, that we're short, and you already saw that, in fact, at the moment at least, we're long. We're not short. So this is going to really mess up your trading opportunity if you're just following this without some discernment of what's really going on with the premium. Now, we can take that down, cut that period of time in half, as we have here, and yet even in this instance, as you can see, even by using this kind of an arrangement, you're still way off the opportunity to get into the long trade, just simply because it took so long for the indicator to respond. You know, the market had already moved up to 37 and a quarter, roughly, before you even had a reason to follow the indicator to take a long trade. Wouldn't you prefer to be getting it at 36 and a half? The whole point below it. This way you're managing to eliminate much downside risk because you've gotten in so much earlier. And if the market turns against you, you have plenty of time to protect your profits. Now, the fastest that we ever plotted is right here. Now, this is much better, but it's also there's also a fair tendency in this case to get whipsawed. So much better to use the premium, because you know the premium is going to give you a much better feel for what's actually happening. Much better feel. Moved up to probably 37.75 there, and started to move back down. You've seen that. Yep, it's right there. You can see, as this market moved up from this divergence here at the low, give us a little bit more dimension here. Okay. Now, this threshold at 558 is associated with this high of 37.50. So that means that as the Spoos move higher, the premium should move higher. If it fails and becomes divergent, as it does right in here, we're at 37.75, and the premium is down at 6.15. That divergence tells you that there's a problem up here. This market is quite likely going to be moving down, and that's precisely what it does. And it's not just on the ES. You can see it on the ticket. You can see it on the, we're moving over, on the ticket as well as on, well, to some extent at least, on the YM here. YM didn't really begin to respond until over here, as we managed to be at 80 in here, and we stayed at 80, pardon me, that's 81. Let's just read that to make sure. Okay, that's at 80, that's at 80, 81 there, 81 there. Okay, it should have moved up. Okay, so in any case, you know, trading VES, the typical, even the fastest indicators just don't work very well. But when you're reading the premium, you've got spectacular context of what you can expect to be happening on the Spoos because of how the premium works. It's beautiful. So hopefully that teaches you a little bit about how we're coming along with this threshold indicator. It's a beautiful, beautiful system for trading and being able to do it pretty much without anything else. You really don't need anything else once you've learned how to read the premium, because it's better than everything else. So again, we highly recommend this indicator. And if you've got any questions, come and take a demo. We'll show you more. I'm Rod Kusin, Spoon for Risk.